Welcome to the Deep Dive. Today we're cracking open BlackRock's Q3 2025 earnings call. And this quarter felt pretty significant, didn't it? A real test with all the M&A integration finally hitting the books.
Absolutely. It's the first proper look at how giants like GIP and HPS are fitting in, especially with, the whole market shifting. So the mission today is really to get past those headline numbers. We want to understand how these new parts are changing BlackRock.
Right, how that infrastructure piece from GIP, the private credit from HPS, and even Preqin's data are reshaping things. And maybe justifying that surprisingly bullish guidance.
Exactly.
Okay, let's kick off with the financial snapshot then, because the market reaction was, well, pretty positive right out of the gate. On an adjusted basis, BlackRock really delivered. Adjusted earnings per share, $11.55. That comfortably beat the consensus, which was hovering around $11.25, maybe $11.30.
Yeah, solid beat there. And the revenue story was strong too, $6.51 billion. That's up a huge 25% year over year. But there was that one complexity, right? The GAAP earnings per share.
Ah, yes, the GAAP number.
That actually came in lower, down 23% year over year, hitting $8.43.
23% down on GAAP EPS. That sounds dramatic. Obviously, the market looked past it, seemed to understand it with integration costs. But how tied are those costs specifically to the M&A? Any risks they stick around?
That's a fair question. Management was pretty clear on the call, though. They pinned it squarely on non-cash charges and, those one-time costs from closing the GIP and HPS deals. The street basically filtered it out because the core business, the adjusted operating income, was actually up 23%.
Okay, so the underlying engine looks healthy.
Very healthy. And the big number everyone watches. Assets under management, they hit a record around $13.5 trillion.
$13.5 trillion.
Yeah, 13.46, $13.5 trillion, somewhere in that range. That's up 17% from last year. And importantly, fueled by $205 billion in total net inflows just in Q3.
$205 billion in inflows. In 3 months, that's just staggering momentum.
It really is.
But like you said, it's not just happening by accident. It points to the growth engines they've got firing. So what are the key sort of organic drivers here behind the acquisitions?
Right, because organic growth is what really shows the underlying health for the long term. Management highlighted their organic base fee growth.
Okay.
That hit an annualized rate of 10% in Q3, and that's the highest they've seen since 2021.
10% organic base fee growth. That's strong.
It is. And it shows broad demand, across iShares, private markets, cash management, outsourcing. It wasn't just one thing.
And that diversified growth must tie directly into the big acquisitions finally contributing. Let's dig into that M&A integration. How are GIP and HPS actually showing up in the numbers now?
Well, the impact was pretty immediate. HPS closed July 1st, remember, and straight away added about $165 billion in client AUM.
Okay, $165 billion from HPS.
And fee-wise, it was substantial. You're looking at roughly $215 million in base fees coming from GIP, then another $225 million in base fees from HPS. Plus, on top of that, about $270 million in performance fees, mostly from HPS funds doing well.
Wow, so multiple streams kicking in immediately, infrastructure-based fees, credit-based fees, and then that big slug of performance fees from HPS. That's quite a mix. Management keeps saying one BlackRock, right? Not just a collection of separate shops. What's knitting it all together?
It really comes down to their tech platform, Aladdin. That's the vehicle.
Aladdin.
They're determined to integrate these teams fully, use common tech for risk, for client reporting, the whole lot, make the whole platform smarter.
Makes sense.
And even while they're spending on this integration, they didn't forget about buybacks. They did $375 million in Q3.
And they committed to more?
Yeah, they signaled at least another $375 million planned for Q4. So returning capital while investing heavily.
Okay, that execution hinges a lot on the tech. Let's pivot there, because the technology segment feels increasingly central to how people value BlackRock now. Tech segment revenue hit $515 million this quarter. How much of that lift came from the new data capabilities, like from Preqin?
Technology is definitely becoming a core pillar. Preqin, which specializes in that private market data, added about $65 million in revenue in Q3.
$65 million from Preqin alone.
Yeah. But maybe even more important is the underlying growth metric, annual contract value, or ACV.
Right, ECV.
That jumped 29% year over year. That's huge. And it's driven by Aladdin expanding its reach, moving deeper into those private market workflows, the whole GPLP relationship.
GPLP, General Partner Limited Partner.
Exactly. So Aladdin's becoming the operating system, not just for public markets, but increasingly for private markets too, across the board.
And that private data capability feeds directly into what they flagged as a really exciting area. Digital assets and tokenization.
Oh, yeah, they spent quite a bit of time on this.
They're already big players, right? Managing the biggest crypto ETPs, IBIT and Ether, and handling Circle stablecoin reserves. Over $60 billion there.
That's the existing scale, but the ambition, the future goal they talked about, is tokenizing their own long-term investment products. Think tokenized iShares.
Tokenized iShares. What's the real driver behind that?
Well, they pointed to the success of their BOIDL fund, which is already tokenized. But the bigger picture, they see, get this, over $4.5 trillion already sitting in digital wallets globally.
$4.5 trillion just sitting in digital wallets.
Yeah, crypto, stablecoins, you name it. It's a massive pool of capital, mostly younger investors, that traditional finance hasn't really tapped effectively yet.
Okay, but tokenization. It's been talked about for years. What makes BlackRock think they can make it mainstream, especially with, U.S. regulations still being worked out?
Two things, really. Scale and distribution costs. The current system has intermediaries, T+2 settlement. It's slow and expensive.
Right. Takes 2 days to settle a trade.
Exactly. By tokenizing something like iShares, which already has immense scale, they could potentially slash those distribution costs and offer instant settlement. The vision is seamless allocation, crypto, stablecoins, traditional ETFs, all within the digital wallet someone already uses. It's about pulling that $4.5 trillion into their ecosystem.
Bringing digital native capital into traditional finance products much earlier.
Precisely. And they were quite vocal on the call about needing regulators, particularly in the U.S., to provide clarity faster. They want the infrastructure built out to support this.
They see it as a major U.S. leadership opportunity, I suppose.
Absolutely. They want to be the infrastructure provider for this shift.
Okay, let's shift back to the core franchises. iShares hit a huge milestone this quarter, didn't it?
It really did. iShares AUM officially crossed $5 trillion.
$5 trillion in iShares alone. Incredible.
And the flows were strong, too. $153 billion in net inflows for the quarter, mostly core equity and index fixed income, the usual suspects. But they also highlighted the success they're having with active ETFs. That's a big focus for them, trying to get higher fees within that efficient ETF structure.
Active ETFs. Are those gaining traction?
Significantly. They pulled in over $40 billion year to date across their active lineup. They specifically mentioned things like their systematic DYNF franchise, which is now $30 billion, and BIN, their flexible income fund, that's hit $13 billion.
So they are managing to scale higher fee products inside the ETF wrapper.
Definitely proving it can be done at scale.
Okay, what about the other big growth area? Private markets. There's been, some nervousness about private credit risk out there in the market generally. What was this BlackRock's take?
Yeah, they tackled that head on. Management basically pushed back against the generalized anxiety. They said credit quality and deployment in their main vehicles, like the non-traded BDC HLAN and their direct lending funds, remain strong.
BDC meaning business development company.
Right, a way for investors to access private credit. Their point was that the stresses you read about are often in the broadly syndicated loan market or, specific pockets where underwriting might have been looser, not in the core private credit space where they operate with tighter controls.
So they feel their part of the market is sound.
That was the clear message. Discipline matters.
And on the infrastructure side, GIP seems to be firing on all cylinders post-acquisition.
Huge momentum there. The big news was their flagship fund, GIP5, closed above its target at over $25 billion.
$35 billion. That's the largest infra fund ever raised, right?
Largest ever private infrastructure fund, yeah. And they tied this directly to the AI build-out.
The data center demand.
Exactly. They threw out a number. $1.5 trillion in capital needed just for the physical data center structures, the buildings, the power over the next 5 years to support AI.
$1.5 trillion. That's a massive tailwind for GIP.
Creates a huge long-term runway for infrastructure investment. GIP is right in the sweet spot.
Okay, so bringing this all together for investors listening, what were the key strategic catalysts or outlook points management really emphasized looking ahead?
Well, near term, they talked about entering the seasonally strongest Q4 with good momentum. But the really big, longer-term catalyst they're pushing is getting private market strategies into retirement plans.
Into 401ks and the like.
Exactly, specifically through their LifePath Paycheck product, embedding things like private credit or infrastructure into target date funds. That's a potential game changer for retirement savings.
But putting illiquid private assets into a 401k,
Yeah.
that requires a huge amount of due diligence, doesn't it, for the fiduciary?
Precisely, and that's the linchpin. That need for better data, better analytics, transparent performance tracking for these private assets, that's the big opportunity for the combined Aladdin and Preqin platform.
So the tech enables the retirement shift.
That's the idea. Give fiduciaries the tools and data they need to get comfortable including these assets. If they pull that off, well, the target they put out there was continued alternatives growth and synergies, driving mid-teens adjusted earnings growth going forward.
Mid-teens adjusted EPS growth. Ambitious, but you can see the path.
You can see how the pieces fit together, yeah.
Okay, let's transition now. Time for our This Is Not Financial Advice segment. We've heard the results, the strategy, the integration progress. If we put on a slightly more speculative hat, maybe think like a hedge fund analyst looking for an edge, what's a potential trade idea based on all this?
All right, purely speculative, of course. But if you really buy into that tokenization thesis we discussed,
the idea of tokenized iShares and tapping into that $4.5 trillion in digital wallet.
right. If you believe BlackRock scale combined with the instant settlement and reduced costs of tokenization is truly disruptive, faster than the market thinks, then the non-consensus trade emerges. The street still mostly values BlackRock like a traditional asset manager. The high conviction idea is that this tokenization initiative warrants a re-rating. It's not just asset management anymore. It's becoming a fintech play, at least partially.
So how would you structure that trade? Again, not advice.
The play could be twofold. One, you could consider shorting some of the traditional brokerage or custodial players, the ones most reliant on those old T+2 settlement systems and high distribution costs that tokenization threatens.
Okay, short the incumbents.
And two, you go long BlackRock, BLK. But your thesis isn't just based on AUM growth. It's based on anticipating a significant multiple expansion specifically for their technology and tokenization segment. You're arguing that part of BlackRock deserves maybe a 3x higher valuation multiple, more like a high-growth fintech company than a traditional asset manager.
A fundamental re-rating based on tech disruption.
Yeah.
What's the core rationale that makes this, well, plausible, even if speculative?
The rationale hinges on that first mover advantage. BlackRock has the AUM scale with iShares. They have the proven tech capability with BUIDL and the Circle partnership. Tokenization allows them to bypass intermediaries and offer instant settlement, directly targeting that massive pool of young digital native capital sitting in wallets. If they capture even a fraction of that $4.5 trillion and do it at potentially higher effective fee rates because of lower distribution costs,
it accelerates their fee growth and fundamentally changes their margin potential faster than anyone expects.
Exactly. It's about the speed and scale of disruption hitting the wealth distribution model.
Fascinating idea. But we absolutely have to stress, this is purely a thought experiment, illustrative, definitely not financial advice. Please do your own research.
Couldn't agree more. Purely speculative.
So wrapping up the core story from Q3, it really felt like a demonstration of scale and solid execution from BlackRock. They delivered strong growth across the board, integrated those massive acquisitions effectively, and are really pushing this vision of a single tech-enabled platform across public and private markets.
Yeah, they're executing today while laying the groundwork for what could be some pretty seismic shifts tomorrow, especially around that digital asset integration. Which leads us to that final provocative thought, building on what we've discussed. If BlackRock actually succeeds in bridging those trillions sitting in digital wallets with mainstream retirement savings via tokenized ETFs, how quickly could that fundamentally alter savings rates and wealth accumulation for the next generation, not just in the US, but globally?
What happens when digital wallets and 401ks effectively merge?
Yeah.
That's a profound question about the future of capital formation. Definitely something to think about. Thank you for joining us for this deep dive into BlackRock's Q3 earnings. We hope you found it insightful, and we invite you to share your own takeaways.